Welcome to DACM Insights. This is a podcast where we bring interesting institutional grade crypto projects to institutional investors to hear about the exciting things happening in Web3. We think this space is still the most exciting, highest growth tech that there is in the world. So it's our pleasure to bring some of the founders that we respect and invest behind to present to you the businesses that build in and show you the real things that are happening in crypto. We've got Guy Young with us from Ethena today. Guy, thanks for joining us.
Yeah, thanks for having me, Richard.
Guy, before we jump into what I think is one of the most interesting projects in crypto that you've been building for some years now, maybe give us a little bit of your background, how you found your way to crypto from TradFi.
For sure. So, I used to work in TradFi, as you mentioned, was focusing on financial services, distressed, special sits type investing across the capital structure. Actually spent some time not too far away from you in Australia in as part of that role. And I guess it was kind of tail end of last cycle, just after Luna was collapsing and FTX was going down, when I left my job and started thinking about putting together what we have now with Ethena.
Before we get into where you can take the product from here, maybe let's just frame it for the listener. How has Ethena been able to grow that fast? How did it differentiate itself from Tether and USDC?
Yeah, it's really just thinking about like the nature and fabric of the product is pretty commoditized, right? It's very difficult to actually differentiate when you kind of just have to be a dollar, you have to be liquid, and then return or yield is kind of the only axes on which you can actually compete as a startup going into this market. I think the view that we had was being able to produce a structurally higher return on dollars was a competitive edge for some use cases that you'd actually find within this category. So I think one piece that's underappreciated by the market is that there are very different use cases for stablecoins within crypto capital markets and market structure. So some stablecoins are used much more for like trading collateral on centralized exchanges. Others are much more popular as a savings rail for the developing world that exists outside of the US, and others are embedded within the US financial system as like payment assets. So each of those different axes that I'm describing there actually have different issuers who are actually more dominant within each of those. And the view that we had was that if you could produce a structurally higher return on dollars, some of those use cases were just like outright better with Athena's product versus those that you could see in the market now. So I think the ones that come to mind are really like saving. Obviously, when you're producing higher yield, like saving is better there. Collateral when you're trading perps, so when you're being able to trade derivatives and earn a yield on that collateral, it's obviously just massively more capital efficient than not having that. And then obviously using it as an asset that sits within DeFi and sort of backs a lot of other applications there. The yield again allows them to build businesses on top of our core asset at a sort of structural level in terms of how to put together. It's obviously not just backed by fiat stablecoins. The core sort of like yield mechanic or source of return is the basis of trade. So you can sort of think about it as a tokenized basis position that's been put in a dollar format just because we think that's the most ergonomic format for this type of asset to exist. And I think, again, one piece that's slightly underappreciated about this side of the market is that the basis in the futures market within crypto really is like one of the only few $10 billion plus cash flow opportunities that exist within the entire space. So if you take a step back, there's only really three things that actually produce $10 billion of cash flow. It's like Binance equity, Tether equity, and then the derivative market that's spinning off the basis. So just to give your listeners a sense of that size and scale, it's like roughly anywhere between $100 to $150 billion of derivative open interest within crypto, which is growing quicker than even the market caps themselves every single cycle. And they annualize around 10-ish% on that 100 to 150 billion. So you've got $10 to $15 billion of cash flow that's being generated there. And to me, it just felt like a very odd situation where we're kind of starved for cash flow in so many different parts of crypto. And you had this enormous market that no one had tapped into in any way within CeFi. So we're really just like capturing that and putting it in a dollar format to export as like a stablecoin adjacent product.
And so your model gives back that yield to users. The duopoly you mentioned don't. Do you think we end up with a bifurcated market with products like yours where you get yield back, or do you think the whole market trends towards you? Where do we end up?
Yeah, it's funny because I think Tether is absolutely in the camp that you described, but actually Circle have started to edge and kind of transition their business to something that sort of sits in the middle. And I always think the middle is a slightly dangerous place to be, actually, because if you're going to start to compete on yield and your product just produces a structurally like lower return on dollars, that's just a pretty dangerous place to be competing with us. So yeah, I think that the market kind of splits, and I think the Genius Act was actually a catalyst for this, which is it's extremely prescriptive within that act to say issuers cannot share the income that's actually produced on those assets. That's like a whole other discussion for another time in terms of whether that actually makes sense from a consumer perspective. But I think what we start to see is actually the market bifurcates into two different directions, which is payment stablecoins that fit the definition of Genius in a very clean and simple way, And then this bucket of other, which is kind of where Ethena is dominated. You see other projects like Sky, and where I expect actually all the new entrants to come in and actually try and compete, which, we need a different name for what those sort of assets are. We call our product a synthetic dollar. Other people call these things like yield coins. But I do think they're actually fundamentally two quite different products between a normal fiat stablecoin that you see within the Genius and what Ethena is doing.
And so they're much more attractive, I guess, to the financial engineers, right? The people that are worried about their cost of capital, funds like us, that if they can earn an extra yield on effectively a cash collateral sort of product makes a pretty big difference to where they go. Any sense for the relative size of those markets as we sort of project out sort of 5 or 10 years?
Yeah, I mean, JP Morgan took a stab at these type of estimates. So we've obviously got like these, global predictions of stablecoins as a category getting to $3 to $4 trillion and call it like the next 5 years. I think it's pretty ambitious, but I would say kind of broadly consistent with how we view the growth of the market going forward. But like yield-bearing dollars as a percentage of the total market right now is still extremely subscale. It's like sub 5%. And JP Morgan's estimate is that number gets to 30. So I think that's probably like a slight stretch in terms of how far that goes. But I think the insane thing to think about is that if like the market gets anywhere near to the $3 trillion that I was describing there, even a move from like sub 5 to 10% of that market is bigger than the entire stablecoin space right now in terms of these yield coins that will be capturing that share. So I think that's roughly how we think about the market evolving, is that this market goes from a 20-ish billion size at the moment for these yield coins, 20 to 25, to something that's closer to 300 billion in the next few years.
So you mentioned earlier the growth of your product has just been insane. The kind of the only things you see in crypto, right? You've gone up to, I think you've gone above $10 billion. I think you're around about 7 billion today. Where's the sort of terminal velocities? Where does it start to kind of become self-feeding beast and starts to incentivize its own kind of usage based on liquidity and just scale?
Yeah, so I think it's interesting because the sort of TAM that you're addressing is a constantly moving figure, if that makes sense, just because derivatives in crypto are quite volatile, and like the reflexive nature of the space means that when Trump came in, for example, the derivative market like almost doubled in 2 months, and Ethena should have been like 5 times the size that it was to actually fill the capacity that was sitting there. I think if we just look at a longer time horizon, one of the interesting data points is that the derivative market has tended to grow at a quicker pace than like underlying market caps. When BTC doubled in the course of the last cycle, called it like 50 to 100K, the open interest actually tripled in the same period of time. And that's just interesting, like broadly, because if you continue to believe the case that like crypto grows as an asset class from like 3 trillion now over the years to something that's closer to 10, your TAM is sort of expanding at a rate that's actually quicker than the underlying market caps themselves. I do think an interesting thought experiment here is that Athena's been pretty large as like a percentage of the total derivative market at periods of its life. So anywhere between 8 to 10% was like the largest it ever got. I think a maximum sort of constraint within the market is something that's closer to 25% of the total market. So there is still capacity there, assuming there's no growth in the total market. But I think one of the ideas that we've been thinking about quite deeply in recent months, and I think that this is sort of part of a broader theme, which is the perpetuation of other asset classes that exist outside of crypto. I have a pretty high conviction view that the perpetual swap is like one of the best financial instruments that's ever been created. And
I agree.
It's one of the few financial innovations that's actually just better than everything else that we see within TradFi. I don't think it makes sense that retail speculation on equities, for example, it takes the form factor of options. I think that actually trading a PAP, when given the option between the two, retail users have expressed like a very strong view and opinion, as you can see in the data, that they prefer the perpetual swap. So I do actually think that like this instrument is going to get picked up and exported out of crypto into every single asset class that exists, and you can represent with a number outside of crypto. And the second order implication of that is that actually the TAM for what you can put into USD and what you can put into Ethena moves from like 3 trillion of crypto to 100 trillion plus of equities and whatever else can be in there. So I think that that's one place that we're watching with a lot of interest, which is I think that market becomes multi-$100 billion of open interest in derivatives, and Ethena can be a pretty big beneficiary of the growth of that market as well.
Yeah, I guess you're touching upon points that we're starting to see across the, I guess, for want of a better word, the DeFi spectrum as it starts to sort of, I guess, rapidly move closer to, TradFi, for want of a better word. So people like Aave looking to launch credit cards, DeFi primitives, which have obviously grown in the sandbox of crypto and now starting to look to encroach upon, I guess, much bigger markets than that, starting to sort of get integrated into financial products like, Web2 fintech companies looking to offer yield on stablecoins and those sorts of things. Do you get dragged along with that? How do you play in that? And how big does that make the stablecoin market for core financial users that want to earn yield on their product.
Yeah, I mean, it's been core to the thesis since we launched. I think I've always described like our distribution strategy as being like a 3-stage approach, which is you start with DeFi to get the product off the ground. You move into CeFi where you've got, much more users sitting within a crypto context. And then TradFi / FinTech is kind of the final boss in terms of the sequencing that we see over there. It's already happening at some scale. So you've seen integrations from like Ethena into Telegram messaging apps, for example, where you're able to actually just like one click in from your messaging app and get a yield that sits in the background. We're pretty advanced with a few of the real fintechs rather than like crypto sexes as just being an earned product that sits in the background of what they're doing. And I think the cool thing about this product is that, and this is going to sound extremely cliched when I say it, but the addressable market for $1 with a yield is basically every single individual on earth. And so any of these consumer facing fintech front ends, if you can produce a structurally higher return in DeFi and deliver that in a safe and like easily digestible format for these people to integrate, it's just a very easy product that people clearly have demand for all over the world. So I do actually think that this is kind of the final form that DeFi actually takes, which is less of a direct to consumer front end where someone's actually coming, on chain and actually interacting there. It's actually just like more efficient back end infrastructure for existing distribution that lives in the market now. I do think there is a question though, which is, can you start to like own the user yourself? Because there is always a risk. And we've seen that even this week, right? You saw the Kalshi news with Robinhood. This was like 60 to 70% of their volumes. And then Robinhood decided to launch their own prediction market like competitor a day ago. And to me, it's just a very strong signal that like, it's okay to be back-end infrastructure for a bunch of different people, but you're always running this existential risk in the same way that Circle is tied to Coinbase in a very deep way, that like, something changes and then half your business disappears after night. So I think this is a question for DeFi, which is, yes, it's great that you can be back-end infrastructure for these fintechs, other platforms that actually own the user on the other side. But I think the cool and interesting thing that Aave's kind of demonstrated in the last, week with that app that they brought out is that they actually want to go own that user as well. So they're not just the back-end infrastructure. But yeah, I kind of agree with the points that you're making. And I think it's a pretty big transition, right, from where we were in DeFi somewhere in 2020, where there's just 10,000 users. It was just a very different sort of look and feel in terms of what we're trying to deliver, where I think actually DeFi going forward is actually a pretty boring market that's just trying to drive a bit of efficiency in the back end for normal consumer-facing businesses.
Yeah, you go from a product where you've got to be, bang away on a ledger for 7 times to try and earn a piece of yield to, log on to Revolut, click a button, I want to earn yield on my dollars. And who wouldn't want to do that, right? So I think we kind of agree with you that the market's kind of as big as there is people with money, particularly when you start to integrate it into frameworks like you've got in crypto, where it is as easy as just, click, start yielding in straight away. Who wouldn't do that? So
yeah,
I think one of the interesting things, one of the trends that I guess you've interacted with a bit outside of your sort of, your core product is, the rise of digital asset treasury companies. And we've seen through, Stablecoin X, Athena's been probably outside of the mega caps, probably the most sought after asset put into digital asset treasury companies looking to trade on the NASDAQ. How do you see that trend playing out? Why do you think Ethena was so attractive as one of the sort of early sort of, non-mega caps to get attracted to that space?
Yeah, I think it's a good question. It's probably answered by, I think there was just a very obvious mismatch in TradFi on the launch and IPO of Circle. And that was actually a big catalyst for us taking this a lot more seriously. We'd been pitched these stats actually, funnily enough, like in November, December 24. So this was like, basically strategy and sale was the only like person in the market. And it just felt like a little bit odd for us to be like the number 2 behind them when we were getting those pitches. But the moment that actually like set it off for us was when Circle came out. Everyone in crypto got that wrong. Most of the people was like, everyone thought it was overvalued at $5 billion. TradFi just had a completely different view of like this market, which was you're attacking like the TAM of money, and there's multi-trillions of equity value that are sitting within payments companies. Buying that at 10 billion or 20 billion is still a pretty decent like EV bet if you think you're chasing down like trillion-dollar opportunities that are sitting on the other side. So it's a very different like perspective I think that TradFi had versus the people that were sitting within crypto. And obviously Circle ripped to, $60 billion, 300 times earnings within a few weeks. And to us, this was just a very strong demonstration that there is too much capital within TradFi, which is wanting exposure to this theme of the growth of digital dollars. This is the only way that they could express that view. And that obviously the outcome there was obviously, Circle trading the way that it did. And then we had a similar issue within crypto, which was there's not enough money within liquid markets to actually support like token valuations post TGE. There's a ton of VC capital that's sitting there and willing to fund these things at seed rounds. But I think you can chart pretty much anything versus BTC in the last like 2 years And you can kind of see that there is we're struggling generally for like capital and secondary markets to keep these valuations afloat. And so to me, it was just a very obvious like mismatch of there's an undersupply of these, the idea of what Ethena is doing within TradFi, and then there's an oversupply within crypto where we don't actually have buyers. Why don't we put these two things together? And like the DAT was actually just a natural connective tissue between those two pieces. But yeah, I think we took a slightly different path, or the Stablecoin X team did, where it wasn't done with the existing listing and needed to go through like a de-SPAC process. So that's, 3, 4, 5 months out from when we're doing the initial raises. I do have like a bit of a question, and we've obviously seen the market, I don't know if implode's the right word, but definitely cool off like massively in the last few weeks. I think it's slightly different for Ethena, where what we're trying to sell is really just an quasi pseudo equity story, which is like you can buy something that looks and feels like Circle and was, growing quicker and attacking that market. It's less about like a more commodity-like asset like BTC or ETH, where you're just trying to play some sort of arbitrage game around and accumulation around it. Here, it was really just like a wrapper that we could get into equity markets to just get access to those pools of capital that sit within TradFi.
Yeah, I think we see the model probably adjusting over time. These DATs probably end up having to play a much more active part in their ecosystems and move away from just that passive straight look through to a NAV, right? Because I think that's a losing battle longer term. I think we've started to see a few come to market or try to come to market recently where they're putting more operational activity next to the buying of tokens that actually is additive to the overall network. Do you think that's the place where we're going to end up?
Yeah, yes, I think it's an interesting idea. I think the light bulb moment for me there was actually, I was speaking to someone from Galaxy last week, and they said that we were the original DAT, which was like they took Novogratz's family office, BTC and ETH, right? They packaged it up into like a company and then built an actual, multi-billion-dollar business like around us now. The problem is that this takes like 8 years to do that properly if you're going to do that, proper scale and actually build a real business around it. So yeah, I think that's the direction where they have to go. And actually Galaxy was like the original DAT basically that came out, and that's a good blueprint for where that can go. I think you just need to be cognizant around where exactly it is that this DAT is going to be fitting into the ecosystem. I think one good example here, I don't know if you saw the SWI one that happened with Ethena was actually helping support like a native stablecoin issuance on SWI, where the DAT itself was actually one of the issuers and supporting the canonical stablecoin that was being issued there. So I think this is just a very interesting one where like someone who's sitting in a DAT has a bit more sort of flexibility and aggression to move versus like a foundation, and they can be, a business facing part of the ecosystem that can actually just move more aggressively and get this stuff done. Yeah.
And better access to capital, right? Just given the mismatch between token capital and equity markets. I mean, that's one of the interesting things. It must be frustrating for you as a founder and a team. Your business is growing. I don't know what your expectations are, but it's growing to above or beyond anyone's expectations in terms of size and success. You've probably been at least the top 5 most successful projects to come to market over the last few years. Yet your token, like most tokens outside of the top 2 or 3, has really struggled. Is that a pure supply? How does this get fixed?
Yeah, I think it's a few different pieces coming together. It's uniquely challenging when you have your like initial unlocks, I think, and we, raised from VCs and all those different pieces. Not only was it in like a challenging alt market, but actually like the supply of Ethena is kind of 5x'd in the last 12 months. So it's naturally going to be a pretty difficult period for us to navigate, I think, until the crash at the beginning of last month. So I think it had actually been absorbed reasonably well. If you looked at like the circulating market cap chart through time, it had been the supply increase had actually been quite dramatic just because of the unlocks. It's not something that I sit around and sort of feel hard for myself or complain about. I think it's actually just my job to build a better product and build a better business that like forces capital to come in. I always thought this was a bit of a misnomer when you saw some founders on the timeline complaining like, oh, there's not enough like liquid capital. We need to like shut down the VCs and get more liquid capital. That's not their problem. This is a market force where like if your business is good enough and it's trading cheap enough and you're doing things that like warrant capital to come in and find you, there's enough money in the world that will find its way to come and actually bid what you're doing.
Well, that's kind of what the DAT did with you guys, right? Like it saw there's a stablecoin theme there that's underrepresented in traditional equity. It's raised over $600 million to buy E&A.
Yeah. Correct. Yeah. And we just need to continue building those sort of bridges. It doesn't happen overnight where like suddenly there's just like instant access to the whole of the NASDAQ. They all know your story. This is like a, multi-year process to actually get that up and established in the right way. But I think you're right. Like, it's not good enough for you to just sit back and say, my life is unfair. There's not enough like liquid funds in crypto who aren't buying our stuff. It's your job to go and build something that's better, because then eventually money will find its way to support what you're doing. An oversupply of capital in the world, not undersupply. And it's like your job to put yourself at the front of that.
So if you look at What do you think drives demand for yield stablecoins? Is it the absolute yield, or do you think it's the delta to Treasuries? Or, if we move into a lower rate environment, where does demand go?
Yeah, I think it's definitely the delta to Treasuries, and that's a very important point. I kind of see this as the biggest macro tailwind for Athena, full stop, in the next 5 years. In many senses, like Athena launched at the worst macroeconomic interest rate environment that it possibly could have in the last 20 years, which was like your hurdle rate in quotations was 5% rather than 0, where it was in 2021. And so in many senses, Athena's product is competing with USDC sharing 4% on Coinbase with their users. And if that number goes to 2%, the interesting piece of what we saw around this product last cycle was actually the yields were like negatively correlated to Fed fund rates. And that makes intuitive sense, right? Because as people lower Fed fund rates, we get into a ZERP type environment, you punt more on like the long tail of assets, demand for leverage increases, and the interest rates in crypto increase. So what we saw in 2021 was actually ZERP interest rates went to 0 and funding actually went to 30-40% for 6 months during that period of time. That's actually the moment that Athena has been built for, which is like on a relative basis, the product becomes so much more attractive, even if rates are staying flat, if not like slightly increasing when your competing rates are going down. But then also even just very basic stuff like, the whole levered Aave trade that you see within DeFi, which is like collateralize this thing at 10 or at 5 and make a levered return. Well, people are going to be doing that in TradFi at mega scale, right? When the rates start to expand here, which is find some source of borrow within TradFi to actually deploy into this. And I think this is actually one of the key differences this cycle versus last cycle, where there really wasn't connective tissue between TradFi and DeFi in any material sense to close like the credit spreads of crypto versus the real world. I.e., everyone was scrambling at the end of 2021 to create like a crypto credit, delta neutral, market neutral type of fund, kind of towards the end of the cycle. And there wasn't a big way that like $10 billion, $50 billion could actually just flow in and compress the rates and arbitrage the rate between crypto and TradFi. But now you have so many different, venues, whether it's like ETPs on the underlying, DATs themselves. Why can't a DAT go and raise a huge amount of debt and actually come and deploy that into something like USD to generate a spread? So yeah, I think that's actually one of the key macro tailwinds, which I'm super excited about. And I think it affects more than just Athena. It's kind of anything that touches leverage and interest rates within DeFi.
Yeah, because I think we've, what do you think drives the demand for a bigger derivatives market? Is there a lack of funding there, and as we get more funding that helps grow it, or is it user base? Bit of both?
It's just the conviction that asset prices are going to go up, so I need to borrow more than 1 times my net worth to get ahead of that. I think the classic one here, right, was like the ETF announcement at the beginning of 24. You knew that all these spot flows were coming in like a couple of months in Q1 of 24. So you're like, well, I just need to get 5x long now so I can sell it to the guy who's going to be buying spot in 2 months' time. So I think it's all just like, high conviction that asset prices are going up drives that like demand for leverage to be long on the other side.
You were watching the crypto market when Luna happened. We've come a long way since then. Anything positive come out of Luna from your perspective in terms of how to scale a stable coin? At least it shows you could do it quickly, I guess.
Yeah, there were a few learnings.
One is to have the yield coming from a real source, I guess, would be the first one.
That's something like real collateral and a real source of the yield were kind of like table stakes, I thought, after what we saw last cycle. But I also think there is an element of sort of, and this applies more broadly than just the category we're talking about here. But this cycle, I feel like it was all about like pragmatism, and we kind of lost the mysticism of last cycle where everyone was kind of dreaming about, changing XYZ and this is going to, rip up the financial system, or Luna's, changing the fabric of money. This cycle was just like, these are just real businesses that kind of, you can understand mechanically what's going on in the P&L and the balance sheet, where the yield is coming from, all these different pieces. And so I think it was just, the key learning wasn't just, I think, for us, but it was actually just the space in total, which is like these unsustainable like own games and Luna and all that kind of stuff. There's been no interest this cycle, right? Like retail hasn't like jumped into any of these things, which just look like outright, unsustainable sort of loops. And it feels like a cycle of sort of pragmatism versus where we were last time. And even if you think about like the main character type stuff, right? You haven't seen anyone on any scale near Do Kwon's level of, arrogance, outside reach, even some of the investors who might have gone down last cycle. So I think this entire cycle was just kind of like toned down in terms of attitudes and what we're doing.
Natural maturing, I guess, and it also means it's a big addressable market, right? When you grow up, there's more markets to attack and grow into. Yeah. Guy, as a holder of ENA across our funds, we're excited about where you can grow the business from here, for the applications that can be built on top of Ethena. Where's the roadmap over the next few years, and what are the new directions we should be looking for the project to go?
relatively new offering that we put on top of the core products in the last 3 months was this white label stablecoin as a service solution. I do think directionally this is where a lot of the space is going. If whoever's not sort of familiar with this on your side, the idea here is that you actually find an issuer who wants to control the brand, get more of the economics, and actually control around stablecoin issuance on their side, but actually just hand it off to an infrastructure partner that can sit in the background and just solve all of these issues for them. We're seeing a lot of chains, applications, wallets who are wanting to internalize some of this flow, and this whole sort of idea around like how we actually generating revenue start to come like to the forefront of people's minds now, where you're seeing chains, even as one example here with MegaETH. MegaETH is about to deploy and start that chain with USDM as like the canonical stablecoin that sits behind it. And Ethena is essentially sitting in the background with our products there, so that all the flows that come and are built on that ecosystem basically come through into our products in the background. I do think that this is like a macro trend that will continue, where very specific chains, wallets, and applications like Hyper would even do USDH themselves will continue to sort of internalize this. And the view that we have is that Ethena is the only issuer at scale with both, a synthetic, higher yielding alternative, but then also a Genius compliant stablecoin with USDTB, being able to offer both and afford people the optionality to sort of readjust or use one or the other product is actually very powerful for these businesses going forward. So I'm bullish on where white label stablecoin growth can go, and Ethena essentially just sitting in the background for all of these products going forward. I do think that's like an interesting platform as well to start thinking about some of the ideas that we were talking about earlier, which is like the purification of everything, and can like Ethena actually provide liquidity on that exchange on some assets that aren't just crypto, as some of these equity RWA type markets start to evolve there. And then I think the final piece that is outside of Hyena is like the exchange is also just thinking about like a consumer facing front end type of offering. I think a lot of these neobanks that you've seen within the market right now are kind of just like, rain debit card slapped onto someone else's stablecoin. And actually the core unit economics and where you capture the value within these offerings is, do you control like the float and the NIM of the stablecoins that sit in the background? And so I think Ethena is in a pretty unique position because you control like the most important part of that stack, which is the highest yielding dollar in the background, which is how you attract all the users to these products. I think there is an interesting opportunity for us to take that up and pick it up into like a mobile consumer facing experience, which is just very simple. I would sort of categorize it as like a Revolut running on stablecoin rails.
Great. Thanks for joining us, Guy. And thanks for walking us through the plans of what we think is probably one of the highest quality projects in crypto.
Appreciate it. Thanks for your time.
Thanks everyone for listening to DACM Insights. If you found this interesting, please sign up to receive our weekly newsletter, and there'll be more of these coming as we look to introduce more projects that we find interesting across the crypto space to all of you.